Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for the chat today, we try and talk about economic cycles versus earnings cycles and where do the two have a confluence or divergence, if you will, because our guest can give us some really strong perspective on that. How to bet on capex beneficiaries, especially if the belief is that we might be in the first half or the beginning of the capex cycle. And of course, can capital good companies continue to trade at FMCG valuations? At least some of them are. Can that continue in a potential long-term capex cycle? To talk about all of this and more, our guest today is Kenneth Andrade, CIO of Old Bridge Mutual Fund. Kenneth, such a pleasure having you. Thank you for taking the time out.
Thank you, Niraj. Thanks for inviting me on the show.
Now, the pleasure is entirely ours, as you know. Kenneth, let's start off with this. I would love to understand from you the perspective of this, this whole conundrum that people have about whether earnings can match up to the kind of valuations given the economic cycle that we have, both globally and locally. What's your sense about this tug of or the push between the economic cycle versus the earnings cycle?
Well, as we've always seen in multiple cases, the earnings cycle is usually back-ended and stocks actually represent, or price earning multiples usually represent the opportunity that is there in that exact space. And that's essentially what's playing out at this point in time. So you'll have to map that entire value chain from the developer. And when I say this on the capex or the infrastructure cycle that we're talking about, from the developer right to the raw material provider, which is the commodity players, and see essentially where the opportunity lies and which part of that value chain can be extremely valuable to own over a long-term perspective. So every investor has got its favorite allocation, right? Now there is an investor who likes capex businesses or developers, but then the balance sheet size that consistently continues to expand. These are companies or these are businesses which attract a lot of bondholders. So obviously their return on capital employed is very close to the cost of capital, or it's an arbitrage between return on capital employed and cost of capital. So that's the developers. Then there is the capex good manufacturers and then the commodity manufacturers. And I think that entire cycle is going to play out as we go through the course of the next couple of years, or next, I would say, all the way to 2030. And this is not just in India, but it happens across the world. And you can see the Western world also trying to put serious capex into play. And that capex in inverted commas is largely linked to power capex or energy capex that is taking place. So I think that's where we are. That's a position that we are at this point in time. And every part of this entire value chain is going to benefit quite substantially.
So, Kenneth, would it be fair to assume that this could be a multi-year capex cycle? We might not be at the very beginning, but we is definitely far away from this capex cycle ending.
Some of these numbers are a little hard to believe, but let me give you a small perspective from 2001 to 2017, and that was probably a cycle that we've seen, or probably I have seen it in my career, right? And I'll talk about just one cycle out there, which is the energy capital, which is power and the kind of power capacities that we put at work out there. Between 2001 to 2015 or maybe 2016, India invested one time is GDP of year 2001. So the day we started our capex, it was one time GDP over the next 15 years that we invested in our power capacities. Now think about it this way: for the next 15 years, if we have to replicate that cycle, the size of opportunity is significant. And how do you capture that, and where do you capture that? And that's what everyone's, and that's what some of the valuations of stocks are foretelling. Okay, so we've gone beyond the value phase or valuation zone to actually mapping some of these companies on the opportunity or the total addressable market that is there. And that makes it very difficult in an environment like this for investors like us to try and pick the right businesses at the right valuation. Okay. So that's where we are at the cycle. We are just about probably starting, and there's one large industry that always leads it. It's not just in India but anywhere in the world. It's basically the energy cycle, and I'll give you a small structural size of how big this opportunity could be.
Okay. So can I just to clarify, just to get this clarification, you are saying that the way it happened between 2001 and 16, if the same thing gets replicated from 2024 or 2023 for the next 15 years, then the size of the opportunity is very large, and as a result of which, you're not getting businesses at the right valuations. Some of the valuations have run up.
That's right. That's right.
Okay, but if the cycle is so long, Kenneth, would you go out and buy some of these businesses even at higher valuations because the opportunity size, I mean, say for execution risks, the runway is very long?
Yes, it depends upon what you want to choose and what you want to participate with. So obviously we are part of the cycle. We like the way the environment's playing out, and I wouldn't say we're very loaded onto some of these businesses, but yes, we've got a fair representation of some of these companies in our portfolio.
Just one quick follow-up question since we dabbled upon energy. It's again a very wide bucket, the traditional energy, new energy, power financiers, ancillaries. It's a wide bucket. I'm just trying to get some sense for our viewers as to what within this whole gamut, maybe I missed something also, but what within this whole gamut do you like more than the others?
I think the contractors, the capital goods companies, and obviously the commodities. And commodities is my favorite for now.
Sorry, did I hear you say commodities is your favorite for now?
Yeah.
Okay, and by commodities you mean uh, fossil fuels, come other aspects which are going into the energy sector?
Uh, may not be fuel inputs, but everything else that goes into building out the capex, that's probably where we are. So
Okay.
everything in the metal cycle seems to be fairly large uh, and and quite reasonably priced, I would say.
Got it. Just one follow-up. So say for some special metals which might be going and which might be hard to get, the base metals and both ferrous, non-ferrous, would there be an overhang of a lack of clarity around China demand, which might be stronger than the longer-term demand out scenario for these companies on the capex side?
So it's a little complicated when you bring in the Chinese environment and why they supply deflation into the economy. Now, this is a complicated statement by itself, but if you notice what's happening globally, right, there is reasonable amount of inflation which is there in the West, and the same holds true for even India or other parts of the world. Now, the only country that's providing cheaper products into the marketplace right now is companies from the Chinese economy, right? Now, when you link that, they are providing cheaper products into the global environment. If you link that to the Chinese stock market, okay, so lower prices is lower profits for the Chinese, which leads to lower market capitalizations, and that's what the entire Chinese economy is stuck with. So our sense is that this may not be we may not continue this scenario in perpetuity, and there may be a cycle somewhere between maybe a year, 2 years, where this actually reverses. So in our limited understanding of capital cycles, the deflationary impact that or the lower prices that the Chinese have been supplying the world with, okay, may not last into maybe another 1 year, maybe maximum 2 years, and that will bring back pricing into virtually every product that is there on the ground, and it could be inflationary, but it's very good for corporate profits, and I think that's what our take, and that's why we like some part of the commodity basket extremely well.
Got it. And can I do a follow-up before we take that break? And therefore, how does that augur for the end user segments, Kenneth? For now, or at least the better part of 2023, some of these companies have benefited or shown earnings growth not because of volume growth necessarily, but for margin expansion that has happened, presumably because of low costs as well. Does that change?
Of course, it will change. So, Neeraj, if you essentially look at the way the environment keeps moving, margins keep moving from one part of the value chain to the other part of the value chain,
Right.
right? So, when you had a commodity boom in 2020 and 21, the converters suffered. Okay, and then you had the users or the converters who did well in the last year or two because the commodity prices came off. Okay, so margins will be always transitionary, but over the cycle, over a longer term cycle, both benefit, and that's why that's why you'll have an economic expansion.
Okay. Um, Kenneth, the other argument, I'm just rounding off, or maybe we'll talk about the other aspect on the capex side, on the other side of the break as well. But just one quick follow up on this, and which is you've constantly told me, right, about the deleveraged corporate balance sheet and how that augurs well for India Inc.'s capability to undertake capex. Hitherto, save for select sectors, and please correct me if I'm wrong, but we haven't seen the advent of private capex in a meaningful way. Does that change in FY25 or calendar year 24?
I think 2025 you'll definitely see the advent of private capex.
Why that belief, Kenneth?
Hmm. All of us, I mean, if you get on the ground, everyone's running out of capacity. And if you have the government continuing to spend and incentivize capex, you will see that come back very, very strongly. Private capex.
We are talking about capex, couldn't quite ignore what's happening to some of the high-flying movers in the session today, one of them being ABB. UBS has come out with a note there talking about why the valuations could be premium for ABB going ahead. Anushi Johnson, for a very quick perspective there. Anushi.
Right, Niraj. So if you look at ABB India, it is trading at its life high today, seeing about more than 6 to 7% of gains. This is on the back of the UBS note, which has implied a price target of about 7,550, so which showcases about more than 20% of an upside over here. Again, a couple of reasons that they have cited. ABB first is the motion and the electrification. The largest segments are expected to drive growth going forward. Also, the focus now remains on its low medium voltage portfolio, which is also expected to remain in the key focus area where there's a lot of scope for ramp up. Again, now if you have to look at the export products portfolio as well, now this will be driven by a more premium mix, which will support the margins going forward. And with now the improvement in margins, that supports the higher premium valuations as well. So this are the couple of reasons why ABB is in focus today and has been gaining about 7 to 8% of gains in trade.
Thanks, Anushi. Thanks a lot for that. Kenneth, just one last question on this whole capex thing and the valuations that some of the stocks are trading at. And now, clearly, different reasons for why different stocks might be doing so, but earnings growth, margin accretion, and the long cycle seem to be the common points amongst all the expensive capex beneficiaries, capital goods space. You believe these valuations could stay elevated for some of these businesses?
Usually, when these cycles last, I think valuations will remain elevated for a very long period of time.
Okay, so that's a clear missive. Maybe some of these stocks may continue to remain expensive. The only reason why I specifically thought of asking this to you, Kenneth, was because I believe in one of the forums you mentioned that some of the capex beneficiaries are trading at FMCG-like valuations. So I was trying to wonder if that could continue or no, but you gave the answer.
Yes, this is the new norm.
This is the new norm. Okay. Is lower valuation and low growth a new norm for FMCG companies in the bargain, Kenneth? We've just not seen them perform. I'm moving tracks now.
I would say low valuation. These are very sustainable businesses that are out there. So they will consolidate around these levels. And I mean, if you look at typically capital cycles or the way money actually works, money is always directed towards faster growth, right? And you've got a situation or you've got an inflection point wherein traditionally all FMCG and consumer names have always grown low double digit, okay, and the highest earnings growth has been probably closer to 20%, but that's no longer the norm right now. and you've got a shift in the way investors actually think about growth. They're moving to something which is much more scalable, larger, etc. So that's how capital moves from one part of the market to the other, and the other part of the market, because there's so much of visibility that is out there, whether it is infrastructure, whether it's power, or whether it's the capex cycle, there is a rationalization in how you see portfolios actually change. So 2010 to 2020, it was all about consumption because in infrastructure, capital, capex, etc., fell off the cliff. I think you're seeing a reversal of that entire cycle between 2022 to 2030 and maybe beyond that for a while. And there's got to be some losers, or there's some businesses, and those businesses are not losers not because they are bad companies, but they just have to go through a consolidation zone. So I think that's what will happen with consumer businesses. Uh, they don't fall off the cliff. There is a reversal to mean. If I remember this right, in 2006, 7, 8, most of the FMCG businesses, including levers, came down between 24 to 35 times earnings. So that's how you will see this environment also play out. I don't know what number they'll settle at, but it could be a stagnant situation for companies like this.
Got it. And viewers, what I meant by lower valuations was relative to history. FMCG companies still don't trade particularly low valuations in the strictest of senses. Kenneth, since you talk about cycles, I would love to talk to you about two pockets which have kind of stagnated for the last maybe couple of years. Maybe so one of them is Speciality Chemicals. The toast of town until 2020-21 suddenly has gone into hibernation as a bucket at large, say for maybe one or two specific pockets. What's the sense here? Do they make a comeback at some point of time, or the survivors particularly of this current cycle?
Mm-hmm. Of course, you will see them revive themselves. When is the big question mark? And obviously, we're going through a supply glut that is there in the international market, obviously driven by one particular country. So we will have to see how that environment plays out. But these are situations that come through. So what happened in 2000? What happened in the early 20s is that you democratize capital for this industry. This industry got capital. They've been able to set up capacities. Now they have to work on cost, and they have to go out and get market share. So this is a period of time where they actually consolidate their business, and they actually and drop costs, go out and get um, get incremental new consumers and customers. And there is a lead time to all of this happening. I think we are going through that lead time. I'm pretty much sure that the next cycle that they'll come through faster. So another industry that went through the cycle is pharmaceuticals. 2015 it hit stop, and 2021, 22, 23, we saw a number of companies take out their previous cycle. That was a 7-year cycle. So you've got to give these companies time. And when I say you've got to give these companies time, I don't mean stock prices time, but you give these companies time to recalibrate their business, look at the business opportunity with a new lens, go out and get market share. And once you get their market share, I think you get back to category dominance. And as an investor, you necessarily have to look for companies with category dominance. And it'll all come through probably in the next 2 or 3 years.
Does the same thing, so just extending that just for clarity, Kenneth, does the same thing hold true for some aspects of pharmaceuticals? I mean, in some sense, the US generic companies have made a first move in calendar year 23. But CDMO, API, and the likes, or all those, have kind of stagnated now for a while. Do they kind of make a comeback too?
You already seen profits out there, and they've made an historical high since 2015. I think 2024, you will have all pharma companies. I won't say all pharma companies. Most pharma companies facing the US come through with extremely high profitability. And I don't see this slowing down, at least for the next couple of years, because there's a lot of capex that is already there on the ground. There are a lot of registrations that have been done. And the best part of all of this is the Indian companies are gaining market share against their counterparts in the West. So it's a kind of an IT cycle playing out, wherein Indian pharma companies are going to dominate. I wouldn't say dominate, but they are going to take their fair amount of market share in the international arena, whether it's the rest of the world market or the US. So I'd watch that space. We are very optimistic about that part of that part of the environment.
Are you taking a are you going out on a limb and trying to take an early position into information technology, Kenneth, or are you avoiding it? The commentary, even from Accenture recently, had no ray of hope, if you will.
Mm. So they are fairly mature companies. So let's divide that into large companies and small companies. The large companies are fairly mature businesses. Now, to trade them at extremely high multiples may not be the right case. To see them dip in terms of margins and retrace them back immediately over the course of the next 1 or 2 years is extremely difficult. So you have to grade yourself. They're not going to be. They're not going to be businesses that they're going to be very stable businesses and a very stable part of your portfolio. If you expect some of the large IT companies to have a blue sky scenario, it may not be the case out there. So they're stable businesses, great for a part of the portfolio. Look for kitchen sinking in some of these companies as new managements come in place. Take the opportunity of that and utilize that. So it comes down to very stock specific and stock picking in this industry. And I wouldn't categorize the entire industry as a buy.
Okay. Specific pockets within there. May I ask you, what is it that you are most constructive on? And I'm not talking about a specific timeline of 12 to 18 months. You could well be investing because you invest at times for a very long period of time as well. Where is it that if you had a chance to put in money currently without bothering about when the return will come, as long as the return is magnified, what would that bucket be?
Okay, let me break this down. Okay, so we are at 3% or 3.5% of world GDP, and we are at 22-23% of population. And as we continue to grow, we have to take market share from the rest of the world.
Right.
Now, you have to go and figure out companies that will build their franchise in the rest of the world. That's one element of all of it. We've seen how much wealth IT has gotten created. We've seen the dominance of Indian pharmaceutical businesses in the West. We've seen how Indian chemical companies have gone out and made their mark. And from there, you will see multiple number of more businesses. I mean, we are the second largest steel manufacturers in the world right now, and we're growing capacity out there. So all of this is coming together quite nicely. Now, pick your franchise out there, and this is the large trend that is playing out. Domestically, infra businesses and utilities, I mean, they are expanding or at least the numbers that if you put the numbers together, it's going to be a scale business that is out there. Now, in that scale business, you got to allocate your capital to parts of the value chain where you feel comfortable with and where you think the returns will I won't say it's a back-ended, but which will be out which will to have a large extent an outlier return out there. So these are the two pockets that are there. The third pocket, which is the consumer economy, I think that will come back. It might have a shorter cycle than the last time, but whenever it does come back, you've got to be a little ready for some of those businesses. Now, case in point is if you look at all the QSR businesses, they're going through a massive expansion in number of stores or in capacity, not number of stores, in capacity. But the market cap has gone just one way, which is down. So look for these trends, look for a bottoming out of the entire cycle, and just work your way around it. So the first two are my priorities. The second one is essentially the third one is essentially something that we're waiting and watching for.
Kenneth Andrade, such a pleasure talking to you in advance. Easter greetings. Have a great weekend.
Thank you, Niraj. Wish you the same.
Thank you, and look forward to talking to you more often. Most importantly. Well, viewers, that's all that we have on this edition of Talking Point. Thanks so much for tuning in.